Sure, I think it's a great question. I think the biggest challenge in this environment is being patient. I think we've been in an environment since the great financial crisis. It's effectively been a bull market for credit. I think we've never seen rates move this quickly from 0 to effectively 5% on the short end. And I think the impact of cost of capital on borrowers is to be determined. So I think the most important thing is having a differentiated sourcing channel, being patient and not being in parts of the market that are increasingly crowded, and making sure that you continue to underwrite creditor protections that frankly have come out of a lot of parts of the market. And ultimately that's what allows you in downside scenarios or more recessionary environments, the ability to protect investor principal. And we're starting to see some of that deterioration in the private market. And I would say anybody thinking about the private credit space has to be very diligent in making sure that when they're lending money to companies, they know what they're actually protecting against. Just from a background standpoint, most of my team members come out of a distressed investing experience. So we're always thinking about downside. So the market environment really plays to our strengths. What's happened over the last couple years, really since COVID, is you've had to put effectively regulation, government intervention to basically protect asset values. And I don't think you're going to have that going forward. So downside protection, thinking about base case scenarios isn't where you focus. You think about downside protection in your downside scenario. So that's a very important point. And when we look at opportunities in the private market, they're increasingly coming from the public market, where markets are shutting to borrowers in the sub-investment grade space very quickly. The amount of debt that needs to be refinanced that's going to have to come to the private market is pretty significant. So, the goal is obviously as those opportunities migrate, making sure credit selection is of utmost importance, and then also making sure that when you're structuring your deals, you're providing enough protection to allow you to get to the table when companies have problems, because it's going to happen. We have been in a benign environment. That is changing as we sit here looking at 2024 and beyond. Sure, I think from a geography standpoint, I'd say it's pretty broad-based. In our private business, we're not focused on specific markets other than what I would say are a couple of guiding principles. One is we need to understand legal jurisdiction. We need to understand creditor rights. That tends to lean towards North America and Western Europe. We are finding a lot to do from a geographical standpoint across borders. So borrowers that have operations across borders, so there's some natural complexity, which causes a lot of traditional private credit managers to shy away from those opportunities. And I think as it relates to sectors, I think it's broad-based. So you can look at what's going on in the telecom space, the tech, legacy tech, lots of leverage, slowing growth, debt maturing. That's a very robust area to spend time. I think if you look away from that, the impact of bank regulation post Silicon Valley Bank, Signature Bank, that has created heightened scrutiny, the need to dispose of assets. Those are coming to the private market looking for a solution, and we think that's going to accelerate. If you think about bank balance sheets, they're going to have to de-lever. They're going to have to come into a market where asset prices have to drop in order for markets to clear. And we think that's a huge opportunity for financial services around increase in regulation, either through SRTs or otherwise. That is an area we are spending a lot of time.